What if I told you the US economy just missed its jobs target by 23,000 jobs, and that number could be more important than it looks? The US was expected to add around 165,000 jobs, but the actual number came in at just 142,000. And that's not even the biggest problem. Previous months were revised downward by 86,000 jobs combined. So, is the American job market finally cracking? Or is this just a temporary slowdown? Because what happens next could affect interest rates, the stock market, mortgages, and millions of Americans' wallets. Let's break it down. Let's start with the numbers. The market was expecting approximately 165,000 new jobs. Instead, the economy added only 142,000. That's a miss of 23,000 jobs. At first glance, 142,000 jobs might actually sound pretty good. And technically, it is still job growth. But financial markets don't only care about whether jobs are being created, they care about whether the economy is performing better or worse than expected. And that's where things get interesting. Previous employment numbers were also revised lower by approximately 86,000 jobs. That means the weakness isn't necessarily limited to 1 month. The bigger question is the US labor market losing momentum? Here's why this matters. The American economy is heavily dependent on consumers. People work. They earn money. They spend that money on houses, cars, food, entertainment, and services. Businesses make revenue. They hire more workers. And the cycle continues. But when hiring starts slowing down, that cycle can weaken. Imagine you're running a business. If customers start spending less, your revenue falls. You become more cautious. Instead of hiring 10 new employees, maybe you hire 2. And if enough businesses do this across the country, employment growth starts slowing. That's why investors watch jobs data so closely. Because the jobs report isn't just about jobs. It's a window into the health of the entire economy. And now we get to the really important part. The Federal Reserve. The Fed has a difficult balancing act. If inflation remains too high, the Fed may want to keep interest rates higher for longer. Higher rates make borrowing more expensive. That can slow spending and investment and eventually help bring inflation down. But there's another problem. If the Fed keeps monetary policy too tight for too long, it could put even more pressure on businesses and the labor market. And that's where weaker jobs data becomes important. Because if employment continues to deteriorate, pressure increases on the Fed to consider cutting rates. But here's the catch. The Fed doesn't want to cut too aggressively if inflation is still a problem. So the central bank could find itself trapped between 2 risks. Inflation on one side, a weakening economy on the other. And markets will be watching every jobs report for clues about which risk is becoming more dangerous. So what happens from here? There are 3 major possibilities. Scenario number 1. The slowdown is temporary. If future jobs reports rebound, wage growth remains healthy, and consumer spending stays strong, this could simply be a weak patch. In that case, markets may calm down. Scenario number 2. The labor market keeps weakening. If job creation continues falling and unemployment starts rising, recession fears could become much stronger. That could put serious pressure on the Federal Reserve to lower interest rates. And markets could become extremely volatile. Scenario number 3. We get the worst combination. The economy weakens, but inflation stays stubbornly high. That's the nightmare scenario. Because the Fed would have fewer good options. Cut rates too quickly, and inflation could come back. Keep rates high, and the economy could weaken further. So here's the biggest takeaway. Don't look at the 142,000 jobs number by itself. Watch the trend. Are job gains getting smaller? Is unemployment rising? Are previous numbers being revised lower? And most importantly, what does the Federal Reserve do next? Because one disappointing jobs report doesn't automatically mean America is heading into a recession. But if weak employment data becomes a trend, the story changes completely. And that could affect almost everything: stocks, bonds, interest rates, mortgages, the dollar, and your personal finances. The US economy isn't necessarily crashing, but the warning lights are getting harder to ignore. So the real question isn't whether the economy created 142,000 jobs. It's this: what happens if next month's number is even worse? And that's the number Wall Street will be watching.